Afternoon, everybody. Hope you enjoyed the presentation so far. In this session, I'll share with you our views on China and Hong Kong strategy in the third quarter. And this will be my key discussion points today. Uh, okay, so the second quarter is really a very boring and lackluster second quarter if Hong Kong and China markets are concerned. The Shanghai Composite Index was up 3.4% in the first half and up 4.4% in the second quarter. If you remember, we have a previous index target for the second quarter. Our previous index target for the second quarter for Shanghai Composite Index was 3580 to 3300. So if you look at the high and low hit in the second quarter, actually it was not too far away from our forecast. In the second quarter, the Shanghai Composite Index, the highest point was 3,629 versus our forecast of 3580. The lowest point was 3394, which was 94 points above our forecast of 3,300. So our index target for the second quarter was quite close to the actual trading range for the Shanghai Composite Index in the second quarter. If you remember, last time we gave two ETF picks on the China market. Among the two ETF picks, the first one, CSOP A50 ETF, ticker 2822. It hit the highest price of 21.26 in the second quarter, and the lowest price was 18.39 Hong Kong dollars. And our previous recommendation was to buy at $19 and sell at $21 and stop loss at 18. So if investors did accordingly, investors should be able to make a profit because the target price was slightly below the actual peak at the peak in the second quarter, and investors should be able to buy at $19. And there's no, since the ETF price has never dropped below 18, so there's no stop loss. As for the other ETF that tracks the CSI 300, the CAM CSI 300, ticker 3188, our previous recommendation was to buy at 60 Hong Kong dollars, target $66, and stop loss at 57. So the ETF went up to 66.88, and the low was 59.08. So our recommendation also works well, because if investors bought at $60, they are able to buy at that price, since the ETF has hit 59.908 before rising to 66.88. And then the actual peak also is higher than our target price. Okay. So that's the performance of the Shanghai Composite Index. As for the Shenzhen Composite Index, it was up 4.8% in the first half. And in the second quarter, it outperformed the Shanghai Composite Index by rising 10% in the second quarter. Second quarter means quarter on quarter. Okay. But the outperformers is the Chinex. Chinex was up 70.2% in the first half and up 26.1% in the second quarter. You can see the rally in the first half, a very strong rally among Chinex stocks. Okay, as for the Hang Seng Index, it was a bit disappointing, because it was up only 5.9% in the first half, and in the second quarter, it was up only 1.6%. So our previous forecast for the index target for Hang Seng was 29,800 and 28,000. So we are actually projecting a tight range. So the actual index range was quite close to our forecast. The highest point was 29,491, about 300 points below our forecast. And the lowest point was 27,716, about 300 points lower than our forecast. Okay. So we recommended one ETF last time in our April presentation in the second quarter. That is the Tracker Fund 2800, the ticker. Our recommendation was to buy at 28.5 Hong Kong dollars. We have set a target of 30 Hong Kong dollars, stop loss at 27.5. So the actual highest point was 29.80. Just 18 cents shy of our target, and the low was 27.90. So it also has not hit the stop loss. Investors who have bought at 28.5, if they are a bit flexible, they should have liquidated or sold the stock around close to 30 Hong Kong dollars. Okay. But for the Hang Seng Tech Index, it was quite out of our expectation. The Hang Seng Tech Index was down 3.2% in the first half and down 0.4% in the second quarter. Our previous index target was 9,320 to 8,000. So the actual highest point and lowest point, the actual range of the index in the second quarter was a bit far away from our previous forecast. The highest point was for the index was 8,669, and the lowest point was 7,433, which unfortunately has been breached recently during the recent sell-off starting in July. So last time we recommended two ETFs which track the Hang Seng Tech Index. Among them, one is CSOP's Tech ETF, ticker 3033. Our recommendation is to buy at $8, target $9.30, stop loss at $7.40. So the highest price only went up to as high as $8.59, below our target price. And if investors follow our recommendation, they should have cut loss at $7.40. So the investment results for the tech ETF was not as good as that on the Shanghai A-share and Hang Seng ETFs. As for the other ETF, tech ETF, iShares Tech ETF, ticker 3067, our recommendation was to buy at $17, target set at $19.50 and stop loss at $15.60. So the highest price in hit in the second quarter was $18.06, also below our target price. And the lowest price was $15.52, also slightly below our stop loss. So investors who had bought this ETF should have cut loss according to our recommendation. It may not suffer further losses despite the ETF was continued to decline in starting from July. Okay. Now let's look at the how China's economy fared in the first half, and I will also share with you our forecast second half outlook of the Chinese economy. Actually, it can be summed up by two words: slowing down. Growth is slowing. China's economy has remained stable in the first half of this year generally, but shows signs of slowing down in the second quarter. I'll show you the recent economic indicators that confirm this trend of slowing down. As last year's low base impact fades, domestic economic activity is expected to continue to normalize, will gradually return to pre-pandemic growth. However, economic growth remains uneven. with the recovery of the demand side of the economy, that is retail sales, still lacking the production side, industrial output. So I pointed out in my last presentation that the first quarter growth, economic growth in China was led actually by the production side. A resumption of manufacturing activities caused industrial output to rise, but consumption still lags behind production. That's the uneven development now China is facing. Okay, let's look at the major economic indicators, which all show signs of slowdown. Property investment, fixed asset investment on the left, you can see that the first 5 months, FAI, the growth rate declined from 35% to 15.4%, and but compared with the 2019 level before the pandemic period, the FAI growth came in at 8.5% during the first 5-month period, and the average January to May growth rate in the recent 2 years stood at 4.2%. Slightly lower, I would say, not very impressive kind of growth rate. The chart on the right-hand side shows real estate investment. Also, you notice the deceleration from from the beginning of the year. Real estate investment growth continued to slow down in May as policy tightening on developers' financing and mortgages gradually kicked in. Regulatory measures include borrowing caps placed on developers known as the 3 red lines, 三条红线, and caps on property loans by banks. Okay, so we expect this control on the property market to continue in the second half. So we are downbeat. We are not optimistic about property developer stocks, mainland property developer stocks, because of the tightening that is expected to continue. Okay. We expect more tightening and more deleveraging in the property market. So the left chart shows property sales by floor area and value. The blue line represents the sales in dollar in value, and the yellow line represents sales in gross floor area. So property sales by floor area rose 9.2% in May. This is one single month, slower than April's growth of 19.2%. So a quite remarkable deceleration from April's growth rate. Home prices, however, have been extending gains on a monthly basis, despite rising curbs on developers and buyers. So that's why we expect more tightening and more deleveraging, because home prices have been rising despite the slowdown in property sales. And in certain cities, there are signs of overheating. So banks in major cities recently hiked mortgage rates. This is another reason why we are not optimistic about property developers, mainland property developers. And even banks will also suffer because of weaker demand for property loans and mortgage loans. And also recently there are policy initiatives to nudge the bank to lower the rate so as to help the medium and small size companies. So that will translate into lower profitability for mainland banks, and that also explains why the share price of mainland banks was weakening in the recent months. And we don't expect significant improvement in the near term. Okay, just now we mentioned that during the economic recovery in the first half, actually consumption lags behind production. So retail sales cooled further in May. You can see in this chart from the growth rate of 30 over percent, 30 odd percent in the first 3 months this year, down to 12.4% in May. Because with the normalization of economic activities after as the COVID-19 came under control in China, the pent-up consumer demand that drove the early days of the recovery is fading. And adding to the weakness in retail sales was a lack of semiconductors that are key components in a number of products, including cars, mobile phones, home appliances, and computers. So these also affect the retail sales in those key products. Okay. How about the trade side? On the trade side, imports grow at fastest pace in a decade, outpacing export. The left chart shows the export growth rate, China's export growth rate. And in the right chart, you can see that the import growth rate soared to a 10-year high. Exports grew by 27.9% in May, fueled by strong global demand as more economies around the world opened up. But going forward, the outlook is not too sure because now in many countries and regions, the COVID becomes serious again. So some countries may face lockdown again. So this may affect demand for exported goods from China in the future. Imports grew by 51.1% in May, the fastest import growth since January 2011, which was actually boosted by rising commodity prices. Okay. Industrial output also shows signs of slowdown. So it slows to the lowest rate in 5 months. This is industrial output. Growth in factory output slowed for a third month in May, starting from March. Amid softer export orders and rising commodity prices and factory costs, and a virus outbreak in southern China disrupted port services and delayed deliveries. This virus outbreak occurred in May this year. Guangdong and Guangzhou, the southern China, was being affected, and this disrupted port services and also delayed deliveries. Okay. Industrial profits also, the growth rate also slowed down because of high raw material prices. Compared with the 2019 level, industrial profits rose 48% in the first 5 months. This is the yellow line represents the revenue of industrial enterprises, whereas the blue line represents the profits. So compared to 2020, because of the low base effect, industrial profits grew 83.4%. But if compared to 2019, industrial profits grew at a smaller pace, rose by 48%. So the average January-May growth in 2020 and 2021 was 21.7%. Not bad, I would say. In May alone, industrial profits rose 36.4%, slowing down from the 57% surge in April. Imbalances in profitability became prominent between upstream and downstream firms due to high commodity prices. So in the last few months, you can also see this divergence in profitability among upstream and downstream firms. So the upstream firms tend to benefit from higher raw material prices, whereas the downstream firms suffer. They are facing margin squeeze because of high commodity prices. However, the Chinese government has stepped up efforts to cool runaway metal prices, including selling supplies from state reserve. So you can also see that after the rally in the first 4 months, now copper, aluminum, steel prices are cooling down, and the related stocks also corrected because of government's taking measures to curb, to cool the metal prices. Okay, investors are concerned about about inflation. PPI was a bit disturbing because it went up very sharply, growing by more than 9% in May. But this week, the latest PPI data shows that it is peaking out. I think it has already peaked out. So you can see that PPI was the growth rate has eased to 8.8%, whereas the CPI grew at a very moderate rate, also this moderating from 1.3% growth rate to 1.1%. This is because, first of all, the PPI is not filtering down to CPI. So because of weak consumer demand, downstream companies, downstream firms are not able to raise prices. So that is one of the reasons why CPI remains subdued. The other reason is because pork prices had started to fall very sharply in the second quarter. Take June as example, pork prices fell 13.6% month on month. And if compared to the same period last year, pork prices has dropped more than 36% because now we are entering a down cycle in the pork prices cycle. PPI fell slightly in June as the effect of ensuring the commodity supply and stabilizing the price began to emerge. So we expect both PPI and CPI to continue to ease in the second half of 2021 because of the slowdown in the economy, and also the initiatives taken by the Chinese government to cool metal prices, commodity prices have started to take effect. Okay, what's the outlook of the economy? Both official manufacturing, both official PMI and market Caixin PMI signal further slowdown in the economy. The official manufacturing PMI, this is the manufacturing PMI, this is the non-manufacturing PMI. The manufacturing PMI dipped to a 4-month low in June, weighed by higher raw material costs, a global shortage of semiconductors, and a resurgence of COVID-19 cases in the major export province of Guangdong. Okay, and the official non-manufacturing PMI dropped even reported a sharper slowdown in June amid fresh restrictions imposed across the southern region in China to combat a resurgence in COVID-19 cases. Okay, this is the Caixin PMI. How it looked under Caixin. The Caixin manufacturing PMI fell from 52 to 51.3 in June after new export orders fell. And the services PMI fell also very sharply from 55 in May to 50.3 in June due to the uptick in COVID-19 cases, which reduced travel demand. Okay, but recent data shows that we don't see sharp rises in COVID-19 cases in Guangdong and Guangzhou. So we think this impact on the service sector should be temporary. Okay. Because of the slowdown, we can see that the People's Bank of China, they are shifting towards a bit more balanced policy or even easing policy. We think PBOC, if you have read the news, you may have be aware that after the market closed yesterday, the People's Bank of China has announced a cut in the RRR. So this chart shows that shows China's RRR reserve requirement reserve requirement ratio for big banks, represented by the blue line. So starting from early 2020, it has remained unchanged at 12 point, should be 12.5. And then this is the red line represents PBOC 7-day reverse repo rate. Also remains stable at 2.2%. No hike and no cut in the no change in the reverse repo rate. In comparison, the black line represents Fed funds target rate. So the Fed has tried to keep interest rate at very low level and also bought bonds every month in the amount of 120 billion US dollar to keep the economy growing. But China, because of the quick recovery, strong recovery in the first quarter. So there's no pressure on the Chinese government, on PBOC to take an easing policy stance. But now I think we are starting to see changes. Yesterday, the people before this PowerPoint was prepared before the announcement. So actually it was preluded by the State Council. For the first time in over a year, the State Council, China State Council, indicated that the reserve requirement ratio might be cut. And just one day after this announcement, this indication, the Central Bank of China really cut the reserve requirement ratio by 0.5 percentage point, which is believed that it will release 1 trillion liquidity to the banks. Reserve requirement ratio is the ratio set on the banks that how much money they can lend out. So by lowering the reserve requirement ratio, that means banks are given 1 trillion liquidity that they can lend out. But this is expected to me. If you ask me if it will have a big impact on the stock market, I'm afraid the answer is no, because it is already expected and priced in. And also the 0.5 percentage point cut in the RRR would be less powerful than a interest rate cut. So the Central Bank of the China Central Bank is not cutting interest rate. It's only reducing the reserve requirement ratio to provide more liquidity. Okay. Our second half outlook, we expect growth momentum to moderate further in the second half amid challenges of rising raw material prices and global supply chain disruptions, especially a shortage of microchips. We expect GDP growth of 8.5% for the full year, which is up significantly from the 2.3% seen last year. Okay. What's our outlook on yuan? You can see in this chart, yuan has started a very long period of appreciation from close to above 7 yuan to 1 US dollars to 6.4 something. So this strong appreciation trend from May 2020 to May 2021 saw a reversal recently. It's worth to take note that the PBOC announced a hike of the foreign deposit reserve requirement ratio. So actually they raised the foreign deposit reserve requirement ratio among banks, which clearly signal the PBOC's intention to limit the fast appreciation of the renminbi exchange rate. So we expect renminbi to remain in a rather tight range, trading range in the second half, to trade between 6.4 to 6.5 yuan versus $1. And we also expect the yuan will display two-way fluctuations. That means it's unlike the period from May 2020 to May 2021, you see a one-sided appreciation, one-sided rally in the yuan. Going forward in the second half, we expect two-way fluctuations, and the trading range we expect is between 6.4 to 6.5. Okay. Now let's look at our third quarter index targets and the ETF picks. Okay, our third quarter index target for Shanghai Composite Index, we expect a wider range than the second quarter. So we expect a trough of 3,450 and a peak of 3,640. So based on this index target, we recommend the strategy for these two ETF, A-share ETF. The CSOP A50 ETF, ticker 2822, we recommend to buy at 18.4 Hong Kong dollars, target 2150, and stop loss can be set at 17 Hong Kong dollars. As for the CAM CSI 300, ticker 3188, we recommend to buy at 59 Hong Kong dollars, target 68 Hong Kong dollars, stop loss at 55. Okay, so if you look at the chart, the Shanghai Composite Index chart, it's still staying. The index remains above the 100-day and the 200-day, 50-day moving average. So this yellow line, the 200 is the 200-day moving average. It would be a key support for the Shanghai Composite Index in the third quarter. So we set the bottom of the trading range at 3,450, which is very close to the 200-day moving average. Okay. As for the Hang Seng Index, we are less optimistic because it has dropped below the. Oh, I have not updated this. Sorry. Let's look back at the first chart. Sorry for the omission. Hang Seng Index has remained range bound. It has formed a rectangular shape pattern in the last 3 months, starting from March to June, between 27,500 and 29,500. So this sideways pattern, there's 2,000 points between the high and low. Now, unfortunately, it has breached the support of the rectangular pattern and starts a decline. Friday, actually, it has penetrated, it's dropped below the 200-day, 50-day moving average. The Hang Seng 250-day moving average currently lies at 27,100. Yesterday low was 26,862, but it was the first time after many months that the index tested the support of the 250-day moving average. So we are not surprised to see technical rebound yesterday, the index rebounding from below 27,000 to 27,300. However, we deem this as a technical rebound, and we expect a further decline after the rebound. Last night, the three major U.S. indexes all closed at record highs. It may lead the Hang Seng Index to open up next Monday and continue the short-term technical rebound. But we expect resistance around 27,500 and 27,700, which is the bottom of the previous support level of the rectangular pattern. Now the support being breached will become the resistance. Okay. So we don't a measured downside target would be 25,500. That's how it's derived. It's derived by because the rectangular pattern just now I mentioned is between 27,500 and 29,500. So it's 2,000 points. So after breaching the support at 27,500, you can minus another 2,000 points from 27,500, and that would be the target, the downside target, the target downside for the Hang Seng Index. But we don't expect the index to maybe it will be hit in the fourth quarter. So in the third quarter, we are looking at 26,000 and 27,700. Okay, tracker fund 2800, we recommend to buy at 26.2 if the index goes down to 26,000. So the buy-in price would be around 26.20. Subsequently, if it rebounds to around 27,700, our target price for tracker fund will be 27,060, and stop loss is recommended to set at 25 Hong Kong dollars, which is below the 25,500. Okay. As for the tech index, since it has dropped, so this chart is also not updated. Sorry for the omission. The three charts here, I have not updated the three charts here, but you can refer to the first few charts which are already updated. The Hang Seng Index, you can also see after the sharp rally to above 11,000 in February, then there was a sharp decline. The first, it dropped to 7,433 in May before rebounding. But lately, it's dropped below the 7,433 support or the low seen in May this year. Friday, it went down to as low as 7,150, 7,152. So our index target for the Hang Seng Tech Index in the third quarter is 600. 800 to 7800. There may be a high chance that the tech index will drop below the 7,000 psychological threshold, but we expect support around 6,800. And subsequently, when it stabilizes, we expect it may rebound to 7,800. There are two ETFs investors can choose from. The CSOP Tech ETF 3033, we recommend to buy at $6.90. Target set at $7.70 Hong Kong dollar. Stop loss at 640. As for the iShares Tech Index ETF 3067, we recommend to buy at $14.50. Target price set at $16.30 and stop loss at $13. Okay. Now let's come to the stock pick part. Seeing this pic, this photo, what do you think? What will you think of? Okay, so this is related to the stock that stock pick today. This time, which is Shanghai How High Biological Technology. The ticket is 6826. How High 生物科技. The group is principally engaged in the manufacture and sale of biologicals, medical hyaluronate, and ophthalmology products, research and development of biological engineering, pharmaceutical and ophthalmology products, and the provision of related services. As can be as shown here, the company has 4 business lines or 4 product lines: ophthalmology and orthopedics. This is related to the bones, and medical aesthetics and anti-adhesion. So going forward, the company will focus on these 2 areas, major areas, that is medicines to treat eye diseases, and also products that will make human look more beautiful. Okay, medical aesthetics. So we'll focus on the medical aesthetics part because lately investors are quite upbeat about the potential, the market potential of the medical aesthetic industry. This company is the 2nd largest domestic manufacturer of RHEGF for external use, and one of the well-known domestic manufacturers of HA dermal filler. The product known as Healin Kang He Shu was developed and produced by genetic engineering technology. It is the only epidermal growth factor product in China that has exactly the same quantity, sequence, and spatial structure of amino acids as human nature EGF, and the first registered RHEGF product in the world. Okay, so this is a sample, a picture of its RHEGF product. Okay, the group's HA dermal filler product portfolio has been widely recognized in the market and has become a leading brand of domestic HA dermal filler products for injection. They have now they have reached 4 generations of dermal filler products, which I will talk about briefly. The first generation HA dermal filler, which is branded Haimei Metrofil, is the first monophase sodium hyaluronate gel for injection approved by the former State Food and Drug Administration in the PRC. It's mainly positioned as a popular entry-level hyaluronic acid. Second generation HA dermal filler known as Jiaolan is mainly positioned at the mid to high range and mainly features the dynamic filling function. Third generation HA dermal filler product Hyalumatrix Haimei with linear particle-free characteristics was registered with the now known as National Medical Products Administration, NMPA, in March last year and was launched in August 2020. So this will be the latest product they launched in the dermal filler line. Now they're developing the 4th generation dermal filler, which is organic cross-link hyaluronic sodium hyaluronate gel product. It has started clinical trials since November 2020. This product uses natural materials as cross-linking agents, and its degradation products are amino acids essential for humans. Compared with traditional chemical cross-linking agents, this product provides better long-term safety. In addition, this product is the first one in China to block the site of action of higher hyaluronidase. I don't really know how to pronounce that. And has the feature of long-lasting effect. They have a very comprehensive product line in dermal filler, as well as the algae growth product. Up to now, the group's medical aesthetic products portfolio has formed a complete business matrix covering 4 major categories, including dermal fillers, botulinum toxin. I think this is already getting very popular to treat lines on the face, radio frequency devices, and laser equipment. So now they are also expanding into the devices and equipment area, which can penetrate into 3 major application scenarios for medical aesthetic institutions, life aesthetics, and home aesthetics. I also noticed the recent trend that because of maybe as also a result of the COVID, the pandemic, people stay home, means spend the time at home more, spend more time at home. So they will choose to buy more home aesthetics equipment and devices for medical aesthetics to be used at home. So this will also create enormous demand for home aesthetics. Okay, just now I mentioned that the medical aesthetic industry in China has a very big growth potentials. At present, China has become the 3rd largest medical aesthetic market in the world. But compared with other major medical aesthetic markets of other countries, China's penetration rate of medical aesthetic projects is still at a low level, and potential for growth in the market is still significant. HA dermal filler for injection has become one of the most popular medical aesthetic products among medical beauty institutions and beauty seekers, with relatively higher repurchase rate over time. So there's repeated demand for such goods, for such products, because of its safety, effectiveness, high price performance ratio, and other features. Okay. So this is the financial analysis of the company. It has grown in share price lately. You can see the market cap rising from, this is yuan, for 49 million to currently 393 million yuan. Okay, 393 million yuan. Revenue, in the last few years, it was growing not very rapidly, but going forward in 2021 this year and next year, because of the launch of new products and also the expansion of business lines into medical aesthetic device and equipment. So we expect both the revenue and the earnings will register rapid growth in the next 2 years. We expect the revenue to grow to 1.9 billion yuan next year from 1.56 billion yuan in 1.324 billion in 2020. So you can have a feel of the growth rate. And in 2022, we expect the revenue to further increase to 2.533 billion yuan. As for net income, last year, because of the COVID-19, the impact of the COVID-19, so it saw a drop in the net profit last year. But this year, we expect the company to register record profit, record earnings of 443 million yuan this year. And next year, we expect its net income, net profit to further increase to 588 million yuan. Okay. So you can see the projected growth in this is the revenue, and the green bar represents the earnings, net profit in the next 2 years. Recently, the group has issued a positive profit alert. The group is expected to record an unaudited net profit attributable to shareholders of the company of approximately 220 billion yuan to 250 billion yuan during the 6 months ending 30 June 2021, representing an increase of almost 700% to more than 800% as compared to that in 2020. So our forecast earnings for this year is 443 million. So the company has already issued a positive profit alert, expecting to make interim profit of 220 to 250. So if you multiply that by 2, I think there's a high chance that for the full year of 2021, the actual earnings may be even higher than our forecasted 440 million. Okay. Okay, this is the positive profit alert. Okay. You can see the surge to $150 during late June because of the positive profit alert. But one good thing is after this surge, its share price corrected. So I think it's giving opportunity to investors to enter at a relatively lower price after the the knee-jerk reaction to the positive profit alert. So we recommend to buy at $100. It closed at 107 in last Friday. So we recommend to buy at 100. Target price set at 135 Hong Kong dollars and stop loss at 89. The stock code, the stock ticker is 6826, and the name of the company is How High Biological Technology. Okay. My final slide will be a follow-up on the previous stock pick. I regret to inform that the stock pick we gave last time turned out to be not that good. And if you remember, our last stock pick was Razer 1337. So our previous recommendation was to buy at $2.55, and we set a target price of 336 Hong Kong dollars. However, we also set a stop loss price at 225. So you can see that the share price stay above 250 for most of the time in the second quarter. Only entering early June, it saw a gap down. The share price gap down and started the decline. Currently has dropped below $2. So it's important, it's essential that we have to stick to a stop loss strategy. Otherwise, now you suffer. If you have bought the share and not cut loss, you may be suffering a bigger floating loss. Okay. What is the reason behind the sharp sell-off? We think it's because of the news that the controlling and substantial shareholders, the controlling shareholders is also the chairman and the CEO of the company, and another non-executive director. These two are the co-founders of the company. So they sold an aggregate of 275 million shares or about 3% of the shares outstanding through placement in early June at a 7.5 discount, involving cash of 661 million Hong Kong dollars. Although both the co-founders emphasized that, reiterated that the sale does not represent that they are not upbeat on the outlook of the company. It's more because of their personal financial needs that they have to sell the shares. Yet the market responded, still responded very rather negatively. But actually, the co-founders, after the disposal, the co-founders still control the company with shareholdings of 33.76% by the chairman and 23.06% by the non-executive director. Up to now, the company has not released its first half results yet. So up to now, the company's fundamentals remain unchanged so far. But it has already hit our stop loss price, so we have removed it from our radar for the time being. Just recall one stock pick. I'm not sure if you guys have invested in that company or still holding that we still upbeat about is Yum China. Yum China share price outperformed other F&B companies in listed. I mean, they have the business in China, especially if you compare to Hai Di Lao and Shabu Shabu. You would be happy if you have invested in Yum China instead of Hai Di Lao and Shabu Shabu. Okay, so this comes to the end of my presentation. Since we have more time left, I can take more questions from the attendants this time. Okay. Kenneth has a question for these few stocks. What is my target price stop loss for Tencent, Ping An Insurance, and JD.com? Tencent, it has dropped below 565. So now it dropped to as low as 510 yesterday. So I think it is still it has started a decline and not yet bottom out yet. Yesterday it dropped to 509.5. So I expect the support at $500. Because of the recent sell-off, which is a bit too aggressive, we may see short-term technical rebound. I expect resistance around 550 to 560. 550 to 560. As for Ping An, it used to be one of my top pick among Chinese insurers, but lately I have also removed it from my radar, monitoring radar, because first of all the Chinese insurers actually underperform, and because of the recent investment in some problem debt-ridden property companies, and also lately it has acquired the property assets from a Singapore company, which you may be familiar with, but investors don't respond positively, so see it in a negative light. And in the past, one catalyst for the share price is the spin-off and listing of its fintech outfits. Since the listing of Lufax, now I think all the fintech outfits of the company has been spun off and listed. So there's no more catalyst coming from that angle. Rebound resistance would be first resistance is $75. It closed at 71.25 Friday. Because we see the divergence in the RSI, the relative strength index, we expect it's oversold, and it may be due for a technical rebound. First resistance is 75. and the second resistance is $76.50. Okay. At the moment, if you ask me which insurance stock can buy, I only have one pick, and that is AIA 1299. It will stand to benefit from it. It will stand to benefit from its expansion in China. We expect it will step up. It will fasten its business expansion in China, and also it has a more diversified portfolio because of its business presence in Asia, in Singapore, in Malaysia, Thailand, and Taiwan. So it should be more resilient compared to the other Chinese insurers. As for JD.com 9618, the stock code 9618. We expect support at 260. If it breaches the support of 260, it will be a bad sign. There may be more downside. And then the first resistance level would be 288 to 290. The strongest resistance level would be around 310. Okay, preliminary resistance level is 288 to 290. Very stiff resistance level is expected around 310, and support at 260 should not be breached. Okay. Kenneth, also a question from Kenneth. Jack Ma, Alibaba has been portrayed negatively in Chinese media despite the contributions made to the economy and the thousands of jobs created in Hangzhou, as we know as the close associate of Jiang Zemin. Though the fundamental of Alibaba is good, should we ignore the undercurrents of political pressure faced by Alibaba? What is the intrinsic value target price for Alibaba? 9988. Besides, this is conspiracy theory lah, which I cannot confirm lah. But besides political pressure, I think Alibaba is also facing policy pressure, policy risk. Not only Alibaba, actually, the sell-off among the tech stocks seen recently is very much due to the tightening on internet companies, including antitrust initiatives, as well as privacy concern. So we do expect this policy pressure will continue for the at least in the second half. It will not disappear soon. This will continue to dampen the share price of affected internet companies, especially the e-commerce companies, and now even the social SNS companies are also affected by this policy tightening. So for 9988, originally it shows support at $200, but now it has dropped below the $200. So if you ask me, the next important support level would be 180, which is quite close to yesterday's low, 189.9. So the next important support would be 180. Okay, China regulators scrutinize on China tech companies, which probably result in recent sell down. Example, Hang Seng Tech, any impact to their future earning? Yes, I think they will come from two fronts. First of all, they may be facing huge fines, penalties and fines that will affect their earning, but that may be that should be one-off. But say, for example, the antitrust initiative taken would limit the expansion scope for those companies, and that may have a more significant bearing on future earnings. This is, I think, why investors are selling down those shares, is the concern about future profitability because of that arise from tightening policies from regulators. Okay, let's look at other questions. Yeah. Okay. Can we see other questions? Oh my. Okay. I see here. Please comment on China Mobile, JD.com, Neil, Xiaopeng, and Sinuk. Okay, China Mobile negative because the growth rate, the earnings growth is very slow, and there's still this downward pressure on the fees, the pricing. The government is nudging all the telco operators to lower their fees so as to benefit consumers and also companies using internet service. So China Mobile, this is one of the negative factor is facing. The other negative factors that you may be aware, China Telecom has recently pledged to raise its payout ratio. So both China Mobile and China Telecom, they are seen as dividend play. So after China Telecom raising the dividend payout ratio, it may also undermine the attractiveness, weaken the attractiveness of China Mobile. Just now, okay. Just now, there are a few other questions. Because we have deleted the previous question. So if someone can recall me, what other stocks? Oh, I remember Sinuk. Sinuk also not too positive about Sinuk because the crude oil prices have risen because of the cap on the output by OPEC plus. Yet its share price did not follow the rise in crude oil prices. So my worry is when crude oil prices rises, the share price doesn't follow. So what will happen if the crude oil prices soften and weaken? Then the downward pressure on the share price of Sinuk will be even bigger. Okay, and the chart also does not look promising. Sinuk 883, it has met with stiff resistance at 930, and now it's dropped to the close to the 100-day moving, the 250-day moving average, which is 830. If it drops below 830, I think we are seeing more downside. It may further test the support at $8. Okay. During the first quarter of this year, you recommended Yum China to buy at 448 per share. Then the target price to sell by this year is $545 per share. The highest point Yum China reached so far is 544 during middle of this year, 2021. So by looking at this, I'm not sure whether I should be applauded or criticized because for setting the target not exactly as the $1 above the highest point. Yesterday, Yum China closed at 506 per share. We seek your advice whether you still recommend the same target price per share to sell Yum China to secure profit within the second half of this year, 2021. Yes, we don't see any major change in the company's fundamental. And from its recent first quarter business update, it shows that the company is on track, opening more restaurants in China. So currently has more than 10,000 restaurants in China, and in 3 to 5 years time, it plans to open up to 20,000 restaurants. So we are still optimistic about the long-term outlook of the company. But to play safe, I would recommend you to set a stop profit price so as to lock in profit in case its share price continues to drop. I think you can set the stop profit at 480, between 480 and 490. If it continues to drop below 480, 490, then you take profit, you stop loss. Otherwise, you wait for another upward move to test the 545 target price. Okay. View on SMIC, any concern with US sanctions? I think the major concern now is that the sanction on the company to acquire the equipment, the necessary equipment to produce the higher standard chips, the 14 nano and even smaller, the 7. If there is, because Chinese homemade equipment cannot at the moment cannot be used to produce the 14 nano or even smaller chips. So this will be the bottleneck for its future business expansion. So he has to overcome this hurdle. This is a hurdle for it to overcome. So the share price is also on a downtrend, but not as steep as other tech companies. On the other hand, it still receive policy support from the government, as it is one of the leaders in semiconductors and chips industry in China, and China will step up its efforts to promote more homegrown semiconductor and chip manufacturing, which will benefit SMIC. So I think there should be support around $20 to $21. The chance of dropping below $20 is at the moment, if you ask me, I think the chance quite low for the share price to drop below $20. Resistance would be expected around $24 for the time being. Okay. Fu Chunli asked, does the recent clampdown on DD affect the Chinese tech stocks? What strategy should we take for tech stocks like Alibaba and Meituan? Sell, hold, or buy more on dip? Now our suggestion to investor is, because this policy risk is so uncertain, the uncertainty is so huge for the time being. So there's the risk of buying one stock that is very seriously, like TD, affected by hit by policies. So to avoid this risk exposure, we actually suggest to buy the ETF for the time being. You can just now we have recommended the buy price for the Hang Seng Tech Index ETF. At least it's more diversified. If a few companies among the constituents were hit by negative policies, adverse policies, at least you have the hope of diversified portfolio to protect the investors. So at this moment, I think we'll recommend to buy tech index ETF first. Once the things settle down and the uncertainty, at least you see the uncertainties fading, then you can start choosing individual stocks. But at this moment, I think it's better, safer to just invest in tech index ETF. Okay, what is your view on Weimob 2013? The SaaS concept stocks are now out of favor. I will only say that the outlook, there's no significant change in the company's outlook. But what affects the price, the share price, always the market appetite for a certain sector or industry. Early this year, the market are very upbeat about SaaS company, cloud computing. But lately, it is out of favor. And technically speaking, it has dropped below, breached the support of the 250-day moving average. I think it may test the support of $12. And then the 250-day moving average, the previous, it has formed also a rectangular pattern between $16 and $19. So now it has dropped below 16 as well as the 250. So I expect resistance at $16 when its share price rebounds, and then support, I expect support around $12. Okay, how about Geely? Geely should be fine because of more demand for cars, and also as China's economy is slowing down, one way to support the economy as well as to support retail sales is to roll out policies to support, to stimulate car sales. So I think car makers will benefit from future supportive policy moves. But among the three, if you ask me the topic, my topic among Chinese automakers, I recommended 175 Geely, but at the moment, as things have changed, our topic, two topics would be BYD and Great Wall, because they BYD is selling more electric vehicles, is delivering more EVs. In June last month, it sold more than 40,000 units of electric vehicles in China. Compared to NIO and Xiaopeng, they only sold about 10,000. So BYD is still taking the lead. Is still, and also BYD has the full has developed a full ecosystem of EV car manufacturing, including battery manufacture as well as car semiconductor. So the first, if you ask me, the topic would be 1211 BYD, and the second pick would be Great Wall. Great Wall is picking up in EV sales. In June, it's selling more than 10,000 electric vehicles. Whereas Geely is EV sales still hover around 6,000 and 7,000, which is even lower than the new generation of electrical vehicles makers such as NIO and Xiaopeng. 1211 now is also heading for correction. So I think there will be good opportunity in future to buy at a lower price as its share price starts to correct after the sharp rally seen in May and June. Let's see if its share price will correct towards the 100-day moving average. That's around 195. Between 195 and 200, entry price would be 195 and 200. Okay. What do you think of the prospects of ETF line OCB? Because I'm not familiar with Singapore stocks and Singapore ETF, so I'm sorry I cannot comment on this, and also because I'm not licensed as well. Can you comment on the weakness of Bank of China and Sinopec? Bank of China, just now I mentioned. First of all, in recent years, the earnings growth, the growth rate was very low, between 3 to 5% lackluster earnings growth. And recently, they are last 2 years they are under pressure by the government to make fewer profits so that more profits can be shared with the community, with the society. So that means lower profitability for the banks. And this year, the Chinese government recently is nudging banks to lower fees charged against their customers, their clients. So this will also dampen the profitability of Chinese banks. As for Sinopec, because big bulk of its revenue and earnings profits come from the midstream and the downstream operation of the midstream and downstream operation. For instance, the refining part and the petrochemical production. But rising crude oil price would it is worried that a rising crude oil price would add pressure on will bring about a margin squeeze on its midstream and downstream operation. That's why its share price underperformed that of PetroChina and Sinopec. I may give you some on the share price. 3988 Bank of China now is testing the 250-day moving average, which is around 2.75 Hong Kong dollars. Yesterday, it went down to as low as 273. If it cannot hold above the 250-day moving average as 275, we expect further upside to test further downside to test the support around 260. So it's still on the way down, unfortunately. And Sinopec 386 is also on a downtrend, and now is testing the 250-day moving average. The 250-day moving average now lies at $3.70. So yesterday it hit a low of 365 and closed at 371. I think very likely that it will not hold above the 250-day moving average. It will drop, it will breach the support of the 250 MA. And then the next support level would be 350. What's your view on Sunny Optical? Sunny Optical, we are still upbeat about the outlook, the prospect of the company, because of now he has overtaken his Taiwanese competitor to be the number one in the optics products that it manufacture. its share price rally quite sharply in the last 2 months. So rallying from around 160 Hong Kong dollars to 240. So we expect a correction in the near term. So the correction will also give investors a good opportunity to acquire the stock at a lower price level. We expect support around $210. So if it corrects to 210, I think that's a good entry point. The first target would be 240. If it manages to break above to rise above 240, then you can further raise the target to 270. Okay. If one buys at 210, one can set the stop loss price at 180, using about 10% as for stop loss. Okay. Okay. What's my view on Baidu? It's never gone up since Hong Kong IPO. Because in the short term, it will be dampened by the sentiment. Market sentiment is negative at the moment towards all the tech stocks. So in the short term, I don't think it can outperform. It will perform in line with other tech stocks. That means they will continue to come under pressure. Unless it's AI, I mean the auto driving, it's Apollo project takes off, brings about earnings growth, huge earnings growth to the company. Otherwise, I think it will just be in line with other tech stocks. Okay. One final question. What is my view on China Tower? China Tower, I think, is the most mispriced and stock when being listed. When it was listed, wow, it was trading at more than over 100 times PE. So despite the fact that the company actually recorded fast earnings growth in the last 2 years, yet its share price still dropped to reflect a more reasonable valuation. Now, after dropping to close to $1, is still trading at the moment is 24 times PE. It dropped from more than 100 times to 20 times. So despite the fast earnings growth last 2 years, but close to $1, I think its valuation becomes a fair valuation, and we do expect that it may not drop. Very substantially further below $1. So, but we still don't recommend to buy this stock because there are too many people who are stuck with the stock at higher levels. So it may meet with resistance when the share price try to rally. Okay, so it comes to end of my presentation today. I regret that because of the time constraint, I cannot answer all the questions, but hopefully my presentation today can give you some insights or trading ideas regarding the China and Hong Kong market. Thanks, and looking forward to seeing you again in the fourth quarter, probably in October. Thanks, bye-bye.